Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio. Well, there have been enough data in the last few days and weeks to take a good picture of what's going on in the economy and the markets from a fundamental viewpoint. This is the purpose of this video. As I mentioned to you in past videos, there are a lot of comments about the recession is going to happen next month, the second half, at the end of the year. But as I showed in previous videos, the data are not there. I mean, there is no slowdown really that is meaningful enough. And this, and again, I don't express opinion. I always like to show you the data and then express an opinion. And I let the data speak for themselves. But the point of this chart is showing income and spending after inflation. All my data are after inflation. And as you can see, have been steadily growing from 2023 at around 3%, which, by the way, is the growth potential for the economy is around 2.5 to 3%, closer to 2.5. So 3.3% growth in spending and income is very, very good. This chart shows two sets of data. One is the durable goods orders, and the other one is this consumer spending on big ticket items, which is the red line. Now, the blue line, this one, is the durable goods orders. It's a very volatile time series, depends on many factors. They are big ticket items, so management, when they decide they go either one way or the other, they buy airplanes, so they don't buy airplanes. So it's very volatile. But as you can see, the trend is definitely up. Consumers are doing well because to buy big ticket items, there is a commitment to spend a lot of money. And as you can see, the red line is trending up. So we have growth rate of close to 2-3%. And it's very, very good, quite frankly. What about employment? Well, employment is doing very well. What I'm showing here is employment in construction, which is the blue line, employment in residential and building construction, which is the red line here. And then there is truck transportation, which has been weakening, but now is strengthening again. Why these three data are important? Because as you can see, these are recession, the gray shaded area, and they decline ahead of a recession. The blue line declines ahead of a recession, the green line declines ahead of a recession, the red line declines ahead of a recession. What you see now is all three lines are heading up. So there is no recession around the corner. That's the bottom line. The logistics managers' responsibility are enormous because they have to manage the transportation from supply, transportation, various modes of transportation, and then through warehousing. So they see the whole business flow. And their survey shows that more than 59% are positive, meaning they see solid growth in their business. So this is a very positive indicator we follow very, very closely. This chart shows two graphs. The US, the yield on the 2-year Treasury notes, which is the green line, and then the orange line, which is the commodity index, CRB, which is the index computed on from a basket of commodities. They follow very closely changes in economic conditions. They're very sensitive to changes in economic conditions. So here the economy is picking up steam, slowing down, picking up steam, slowing down, picking up steam. In the first half of 25, there has been a relapse. In fact, we have negative GDP. But now in the second half, beginning in May, you see commodities going up and the 2-year Treasury is going up. So they are responding to the need of management. They are buying raw materials, then they have to borrow money to buy the raw materials. So but to borrow money, they place upward pressure on interest rates. So you have rising commodities and rising short-term interest rates. So this is part of the business that is improving. So again, this is very good news in terms of for people who expect a recession. They should see commodities and short-term interest decline. Instead, they are not. They are rising. So meaning again, the economy is doing well, as we have seen before. We talked about this relationship between Bitcoin and gold in a previous video, and I was pleased to see that there were favorable comments. This chart shows the Bitcoin, the green line, and the orange line is gold. As I discussed in detail in the video, they are, one is a mirror image of the other, basically. Rising Bitcoin means that there is volatility, the stock market is doing well, equity market is doing well, and during those periods when the Bitcoin is rising, usually gold is not performing well. However, when there is a tightening of liquidity and Bitcoin declines, you see gold rising. And this happened strong here, strong Bitcoin, then weak Bitcoin, gold started going up, strengthening. So there is a not perfect, like nothing in life is perfect, but if you expect a strong Bitcoin prices, you should see a weaker gold prices. And this is exactly what we are seeing now. Bitcoin has been soaring and gold, the orange line, has gone nowhere. So as long as there is plenty of liquidity, and the chances are Bitcoin will continue to outperform gold. In fact, every morning when I look at the prices, I always see what kind of market we are facing. If Bitcoin is stronger than gold, then I say, okay, this is going to be a good day. But if I see gold, let's say in the futures before the market opens, stronger than Bitcoin, I know that it's going to be a weak day ahead. So it's a pretty, again, nothing in life is 100% sure, but it's a pretty good rule of thumb to follow. This chart shows the 10-year yields is a red line, this red line, and the blue line is the growth in GDP, gross domestic product, in nominal term. That is, you have growth plus inflation. And what you see is something I've been discussing in every issue of the Peter Duck portfolio, is that yields and GDP growth are always kissing each other. No relationship is perfect, but it's a good rule of thumb to say that yields are roughly equal to growth plus inflation. So let's say growth now is around 2%. Well, actually, it's 2.3, 2.4% according to some models of the Fed, and you have inflation of 2.2, 2.3. You add the two numbers together and you have 4.7, 4.4, somewhere between 4.5 and 5, which is exactly where the 10-year yields is. So when is the time to buy bonds? Well, if you believe that growth is going to be zero and inflation is going to be zero, then probably yields are going to drop dramatically. On the other hand, if growth keeps on going around 2.5% and inflation is 2%, yields are going to be close to 4.5, 4.5%. That is a good rule of thumb suggested by this chart. Well, what about the stock market in the near term? Well, a good indicator of risk is the spread of low-grade bonds and treasuries. And this is what this graph is at the bottom. This is the spread. When the spread rising sharply, there is high risk in the market, usually liquidity is drained out of the system, and what you see is a sharp decline in the market. Here there has been a sharp increase in yields, and here you have a decline in the market. Right now, following this increase in the spreads have been declining. So as long as spreads are not rising, the market should be okay. This is what this indicator is saying. So what is the point of the previous charts? Well, the income and spending is growing at 3%. This is solid growth. Durable goods orders are rising, and consumers are spending on big ticket items. Employment is rising. There's some special sub-employment data. Some sectors are still showing growth. This, like in construction, they tend to decline months ahead of recession. Instead, they're still expanding. We have the logistics managers very positive about the output and business. We have also in the Bitcoin and gold, Bitcoin growing, which is good, positive, with confirmed by gold trading in a range. Usually when Bitcoin is strong, gold is in a range, telling you that there is enough liquidity. Commodities, after a sharp declining in the first quarter, now there is the going up again, showing that the economy is still rising. Yields, again, you don't have to be a PhD in economics to add growth and inflation, and are where they're supposed to be. If growth and inflation declines, they will go down. But if inflation and growth stay where they are staying where the yields should be around 4.5%, if not going higher. The stock market is doing well. Why? Because spreads are declining, so it means that there is little or no risk in the financial markets. So things seems to be okay. It's not. I don't see the data don't show the kind of panic that sometimes some famous analyst seems to to delve into it. And the big picture is still okay. Maybe there is not solid growth, but the big picture is still okay. Of course, stay with us, follow us, and we'll keep you updated when the data will change. I'm sure we will change if the data change. But if the data tells us that things are good, I cannot say things are bad. That you can be sure of that. Again, if you want to, that just to remind you that we have 3 levels of membership. We have videos only, we have videos and financial updates, and then the membership number 3, Peter Duck Portfolio, 22 pages of research, videos, the model portfolios, and market updates. Thank you very much for following this video. I hope you find it useful. And you know where to go if you want to see more of them. Just go to www.patreon.com/Peter Duck. Again, thank you very much for being here, and I hope to see you really, really soon. So long and have a nice day. Take care.